Bernie Madoff, the mastermind behind the largest financial fraud in American history. In 2021, Bernie Madoff, the man who committed the largest financial fraud in American history, passed away. How did he manage to defraud thousands of billions of dollars? And what consequences did he face? Born in 1938 in Queens, New York, Bernie Madoff started his career as a lifeguard and sprinkler installer before founding Bernard L. Madoff Investment Securities LLC in 1960. His firm initially made a name for itself by pioneering electronic trading and quickly grew to be one of the largest market makers on Wall Street. But behind the scenes, Madoff was orchestrating a massive Ponzi scheme that would eventually unravel, leading to his downfall. Madoff began his financial career at the age of 22 with $5,000, which he used to found Bernard L. Madoff Investment Security in 1960. His initial focus was on trading penny stocks, and he quickly gained a reputation for his innovative approach to market making. The company grew to become one of the largest market trading firms, thanks to Madoff's pioneering use of computer technology to disseminate quotes and execute trades. This technological edge allowed his firm to offer better prices and faster execution than many of its competitors. By the 1980s, Madoff's firm was handling a significant portion of the trading volume on the NASDAQ. His influence grew, and he eventually became the chairman of the NASDAQ Stock Exchange, a position he held for 3 one-year terms in the early 1990s. Madoff's rise in the financial world was marked by his ability to innovate and adapt, earning him respect and admiration from peers and clients alike. Madoff devised a Ponzi scheme, paying old investors with new investors' money instead of real profits. This type of scheme relies on a constant influx of new investments to keep the illusion of profitability alive. This fraud continued for years, targeting investors of all types and creating a false sense of security and trust among them, from celebrities to ordinary individuals. The impact was devastating, leading to financial ruin for many and shaking the confidence in the financial system. The mechanics of the Ponzi scheme were simple yet effective, exploiting the trust of investors and the complexity of financial markets to mask the fraud. As long as new investments kept coming in, the scheme thrived, but once the flow of new money slowed, the entire structure collapsed, revealing the massive fraud. The 2008 financial crisis was a pivotal moment in modern economic history. Triggered by the collapse of the housing bubble, it led to a severe global recession. During this period, investors tried to withdraw $7 billion from Bernie Madoff's fund, but he could not meet these demands. Realizing the inevitable collapse of his Ponzi scheme, Madoff confessed to his sons, who then informed the authorities. In 2009, Madoff was sentenced to 150 years in prison, marking the end of the largest financial fraud in American history. The fallout from Madoff's confession and the financial crisis led to widespread changes in financial regulations and a renewed focus on investor protection. Madoff's fraud caused losses estimated at $65 billion, leading to the suicide of investors and the collapse of charitable foundations. In prison, he asked for early release on health grounds, but the judge refused, citing the ongoing suffering of the victims. Bernie Madoff died in prison in 2021, leaving behind a legacy of deception and financial destruction. His story remains a warning about the dangers of greed and fraud in the financial world. Gap 2S. The aftermath of Bernie Madoff's colossal fraud stretched far beyond his victims. It shook the very foundations of the financial industry, prompting a wave of scrutiny and reform. Gap 1S. In the wake of Madoff's exposure, regulatory bodies like the Securities and Exchange Commission faced intense criticism for their failure to detect the scheme earlier. This led to significant changes in regulatory practices, including more rigorous oversight, increased transparency requirements, and the implementation of stricter compliance measures. Gap 1S. One of the most impactful changes was the passing of the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. This landmark legislation aimed to reduce risks in the financial system by imposing stricter regulations on financial institutions and creating new agencies to oversee consumer protection and financial stability. Gap 1S. Madoff's fraud also served as a wake-up call for investors, emphasizing the importance of due diligence and skepticism, even when dealing with seemingly reputable financial advisors. Gap 1S. While the financial industry has made strides to prevent another Madoff-like scandal, The lessons learned from his deception continue to shape the landscape. The story of Bernie Madoff is not just about one man's greed, but a catalyst for systemic change and a reminder of the ongoing battle against financial fraud. Gap 2S. The legacy of Bernie Madoff serves as a stark reminder of the critical need for vigilance, transparency, and ethical standards in the financial world. Because, as history has shown, the consequences of neglecting these principles can be devastating. Gap 3S. Thank you for watching. If you found this video insightful, please like, share, and subscribe for more deep dives into the world of finance.